Hello everyone. Today we are going to discuss chapter 2, and chapter 2 is about how to record the business transaction, and actually this is a continuation of chapter 1 where we discuss the effect of the transaction on the accounting equation. Our learning objective out of that chapter first is to explain accounts as they relate to the accounting equation that we studied in chapter 1 and to describe the common accounts. To define debit, credit, and normal account balances using double entry accounting and T accounts, and to record transaction in a journal and post those journals entries to ledgers. 4. To prepare trial balance and illustrate how to use the trial balance to prepare the financial statement. Finally, to use debt ratio to evaluate the business. First, learning objective, which is what do you mean by account and how it is an equation. First, we have to remind ourselves with the accounting equations that we discussed in chapter 1. And actually, the equation is saying assets equal liability plus equity. And we defined in chapter 1 what do we mean by assets, what do we mean by liabilities, what do we mean by equity, and what are the most common accounts inside each of these categories. An account is the detailed record of all increase and decrease that have occurred in an account during a specified period, which means the assets is an account category that include accounts: cash account, account receivable account, prepaid account, inventory account, equipment account, and this account is a detailed record of all increase and decrease happened as we discussed in chapter 1 that occur during specific. For example, if we are talking about, as we said, cash, so actually we are talking about the business money, include bank balance, bills, coins, and checks. If we are talking about account receivable, this is customers' promise to pay in the future for service or goods sold, often described as on account. This is whenever the company is entitled to receive sum of cash from their customers on short-term basis. Notes receivable is a written promise that customer will pay a fixed amount of money plus interest, and usually it is more formal than the account receivable, which means we have to sign something like a contract in order to record the account as notes receivable. The prepaid expenses is payment of expense in advance, and it is considered as an asset because the prepayment provide a benefit in the future, which means, for example, prepaid expense are prepaid rent, we paid rent in advance; prepaid insurance, we paid for the coverage of insurance; office supplies, we are purchasing office supplies and then to use them. Equipment, furniture, and fixtures. The cost of equipment, furniture, and fixtures such as light fixture and shelving, which is a business has a separate asset account for each type. يعني we have to have an account for the equipment, an account for the furniture, an account for the fixture, and so on. The cost of an office building, a store, or a warehouse. This is a building. Land is the cost of land business use in. Liabilities. Liability account, the most famous one is the accounts payable, and actually a promise made by the business to pay debt in the future, and it arises from a credit purchase. We purchased something but we didn't pay for that thing yet. Notes payable, the same, but actually again it is a written and it includes interest, and normally it is for a longer period of time than the accounts pay. Accrued liability is a liability that is owed but not paid, such as taxes. We are owing taxes to the government, but we didn't pay it yet. Like rent payable, salaries payable. Like, for example, if we're saying electricity payable. Type the unearned revenue. This is occur when the company receives cash from customer but has not provided the product or the service, the promise to provide service or deliver goods in the future, which means we receive the cash before we provide the service. This is to be called unearned because we received the revenue in advance, and this is to be considered as a liability on the company. And we said we have common stock, which represents the net contribution of stockholder in the business, and this is to increase equity. We said we have equity, and we have two main accounts under the equity. The first one is the common stock, if you remember from chapter 1, and those three are to be under the second account, which is the retained earning. Okay, the retained earning. It includes dividend, which decreases equity. Dividend is a distribution of profit at the end of the year when the company make profit. Actually, they're distributing part for the shareholders. So actually, this is decreasing equity. Revenue is whatever we receive from delivering goods or services, and actually this is to increase equity. The expenses is the cost of selling goods or services, and it decreases equity. So actually here, any expense will decrease the equity, any revenue will increase the equity. Dividend will definitely decrease the equity. And if you remember, revenue minus expense is net income, okay, or net loss if the expenses is exceeding revenue. Right. This is to be called the chart of accounts, which means we are making something like a map saying that all the account of assets that we have are including 1, 2, 3, 4, 5, 6, 7. The same for the liability, the same for the equity, revenue, and expenses. And everyone is taking some code, and this code is not unified. We are using this chart in order to organize the company's account, but actually these codes are depending on each company. It is not a fixed or constant chart codes to be used by every company. A ledger is a record holding all the account of the business, the change in those accounts and their balances. What is T account? T account like that, and this will be explained later. The left hand side is always debit, and the right hand side always is credit, and at the end I have to add both sides to find out if the balance is debit or credit. Okay, fine. Let's go and we will see that later. Define debit, credit, and normal account balance using double entry account and T account, and this is the objective. In accounting we use something we call double entry system account, and it to record the effect that we experienced in chapter 1 through debit and credit side. Debit and credit side. For example, office supplies, okay, are purchased for cash, requiring an increase in office supplies. Refer back to chapter 1 if you'd like to. And decrease to cash. So actually, whenever office supplies will increase, we have to debit it or credit it, and whenever cash is decreased, we have to debit. This is why we said that we will have the T account, and the left hand side will always be debit as we said before, and the right hand side will always be credit as we said before. Action will be reflected like that, which means this is asset. It will increase by debit, decrease by credit, and in order to keep the balance between the two sides, you will find out that all the accounts on the other side have a reversing nature, which means it decreases by debit and increase by credit in order to keep the balance. But actually how we record the increase and decrease to an account is determined by the account type. If it is asset, I will say whenever it increases it will be debit, whenever it decreases it will be credit. Liability and equity are the opposite because actually they are on the other side of the equation. Increase and decrease. Whenever the cash will increase due to the transaction that we said we purchased supplies, okay, To increase the cash, a business would record a debit to cash. يعني whenever the cash will increase, it will be debited. And whenever it decreases, it must be credited. You have to keep that in mind and you have to memorize that by heart. Okay. In order to expand that rules, accounting is expanded to include the rule of debit and credit for element of equity. Assets, debit and credit. Liability, debit and credit. But actually you have to keep an eye here. Debit is here increase, debit here is decrease. Common stock, dividend, revenue, expenses. Be careful that these two accounts, dividends and expenses, are having the same directions as the assets. Why? Because actually they are on the right hand side but with negative sign. So actually they are opposite to that nature, which means they are pertaining to that account which is assets. So actually assets, dividends, expenses increasing by debit and decreasing by credit. On the other hand side, liability, okay, common stock, revenue are actually decreasing by debit and increasing by credit. And we have a normal balance for each account. The normal balance is the balance that is the account increases at. يعني the normal balance for asset is debit. The normal balance for liability is credit, because actually it increases in credit. A common stock in credit. Dividend, sorry, in debit. Okay, revenue in credit, expenses in debit, and so on. Okay, assets, dividend, expenses having the same direction of debit and credit. Liabilities, common stock and revenue, okay, are actually the opposite, which is they are increasing in the credit side. And this is what we were talking about now. An account normal balance appear in the increase side. This is why we said assets increase with debit, so the normal balance is debit. Liability increase with credit, so the normal balance is credit. Okay, and this is again a summary for each account, and it increases in which side and decreases in which side, and the normal balance as you can see. Determining the balance of T account, I will accumulate all the debit transaction. We are using here the T account to determine the ending balance in an account, and the ending is shown on the side with the larger number. يعني I will say that I have 30 and 5,500. This is 35,500. Increase in cash because this is the debit side. The debit side, and on the other side I have 23,200,000. If I subtracted the 23,200 out of the 35,500, I will get a balance which is 12,300, and it is toward the debit balance because the balance here, this side is the larger one, the bigger one. So actually, whatever the difference will be, it will be listed in the side of the bigger number. Learning objective number 3, to record the transaction in a journal and post it. Accountants use source documents. يعني in order to record the transaction, we have to have an evidence and data for recording the invoice, receipt, contract, whatever documents that will help business determine how to record. So actually the flow of accounting data will start by the transaction will occur, then a source document are prepared, the transactions are analyzed as we did in chapter 1, then it will be journalized and posted as we are going to do. Like as we said, purchase invoice, bank check, sales invoices, all of those are to be considered as. After reviewing source document, accountants record the transaction, and those transactions record something we call journal. And the journal is the record of the transaction in the date order. We have a table. This table will record the transaction, will include the transaction, record of the transaction according to their dates. Okay, and transferring this data from journal to ledger is called posting. Let's see an example to illustrate what actually happened. طيب, on November 1, the e-learning company received 30,000 cash from Sheena Bright, and the business issued common stock to her. So actually what happened here? If you remember in chapter 1, we said whenever we receive cash against common stock, the asset will increase cash, so it will be debited as you can see, and the common stock will increase in credit. So actually now we have two sides, debit and credit, and both must be equal. So actually now which means this format is the journal. We have date, we have account and explanation, we have debit, we have credit, and we will start here by recording the date of transaction and then the debit account to be written first. يعني الcash increase, so it is debited. So I will start by cash. طب what if any other account have been debited? So I will start by that account. So the debit side always will be written first, and I will write the number here, the amount. And on the other side, the credit side, this is common stock increased in credit. So actually I have to have ident like that, a space, and then I will record the amount which is equal to the other side amount to make sure that there is a balance, the balance that we talked about in chapter 1. So actually we have to have a debit balance and credit balance. Okay. So at the end, this is the journal entry, and whenever I'm going to post it to T account, I will open a T-shape account like that. This is the debit side, as we said before, and this is the credit side. This is the debit, and this is the credit side, and I will name that T as cash, and cash is debited here, so I will report it in the debit side here. Common stock have been credited there, so I'm going to credit it here. Second transaction. On November 2, Smart Touch Learning paid 20,000 cash for land. So in that case, the cash decreased, so the cash became credit, so it will not be written first. The land that we purchased, which is an asset, increased, and we know that the normal balance is debit, so actually the land will increase by 20,000. I will start, so the land is debit, so actually land will be debited for 20,000, and we credit cash for 20,000. The third transaction, Smart Touch Learning buys 500 of office supply on account. So we purchased office supply, so the office supplies increased, so it will be debited because it is asset. And we didn't pay, so the liability increased. So I credited accounts payable with the same amount, and we have always to make sure the balance. Okay. Number 4, earning of service revenue for cash. On November 8, Smart Touch Learning collected cash of 5,500 for services revenue that the business earned by providing service for clients. Actually here we have cash that have been increased because actually we did a service and we received the amount of that service in cash, and the revenue increased, and it is on the other side, which is the number 5. On November 10, Smart Touch Learning performed service for client for which the client will pay the company later. So as long as we did the service will increase in the credit, and it's supposed here to be cash, but actually we didn't receive cash. We have account receivable, and the account receivable is the amount the company is entitled to receive or collect later. Smart Learning Paid cash expense on November 2,000 for office rent. This is the first type of expense. 1,200 for employee salary. This is the second type of expense, and both must be recorded separately. And this is to be called, as we can see, compound journal entry, because we have two debit balances and one credit balance. So actually rent expenses 2,000, salaries expenses 1,200, and the cash is credited with the total, which is 3,002. Transaction 7, payment on accounts payable. On November 12, Smart Touch Learning paid 300 on the accounts payable created in transaction 3. So account receivable decreased because we paid some of our liability, and the cash decreased because we paid for paying that. On November 22, Smart Touch Learning collected 2,000 cash from a client in transaction 5. So again, we collected out of the account receivable, so cash increased in the debit, and whatever we entitled to receive have decreased, so it have been credited by the same amount. Payment of cash dividend. On November 25, a payment of 5,000 cash was paid for dividend, so actually dividend has increased, the distribution has increased, and the cash decreased because you pay it, so it is. Number 10, prepaid expense. We paid or prepaid 3 months office rent of 3,000. Yani we paid in advance 3,000 for 3 months of rent. So actually the prepaid rent is an asset because it will continue with me for 3 months. Okay, and the cash decreased because we paid for 3. On December 1, Smart Touch Learning paid employee salaries of 1,200, so expenses increases in debit side, so I started with that, and I paid cash for 1,200, and this will be purchase of building with notes payable. Smart Touch Learning purchased 60,000 building in exchange for a note payable. So actually building will increase by 60,000 and notes payable will increase by 60,000. The building, because it is an asset, it will increase in debit. Notes payable, it is a liability because we didn't pay, so actually it increased, okay, by the 60,000, and the liabilities are increasing in the credit side. Stockholder Contribution. On December 2, Smart Touch Learning received a contribution of furniture with fair market value 18,000 from Shana Pride. Yani the owner of the company contributed additional furniture in exchange for increasing its share or her share in the company. So actually furniture is an asset that have been increased because it entered the company. And on the other hand, the equity of Shana has increased. So actually it will be credited because this is equity, and equity increases in the. On December 15, Smart Touch Learning received telephone bill for 100 and will pay it later next month. So it is expense, utility expense, debit, and payable liability because I didn't pay, so the liability increased with the same amount. On December 15, Smart Touch Learning paid employee salaries of 1,200, so it is expenses, but here it is cash because we paid. In the last slide, in the last transaction, we said payable because we didn't pay. But once we pay it, we are going to credit cash. You have to be reminded that all what we are doing up till now, that we are using the general rule that we agreed on at the beginning. What is the general rule? Assets, expenses, dividend are increasing in the debit side and decreasing in the credit side. Liability, revenues, and equity are increasing in the opposite side, which is credit, and decreasing in the debit side. On December 21, a law firm engaged Smart Touch Learning to provide e-learning service and agreed to pay 600 in advance. Yani a customer came to me and paid to me 600 in advance for service to be done later. This is actually a liability The cash will increase by 600, so it is debited, and the unearned revenue will, this is a liability account until we provide him with the service. So actually it will be credited for 600, so it increased in the credit. On December 28, Smart Touch Learning collected cash of 8,000 for service revenues that the business earned by providing e-learning service for clients. So actually here I provided the service and I received the cash, so the cash increased and the service revenue also increased in the same time. So here the transaction is, so actually now all what we have done was to record all the transaction happened in the debit and credit side inside the journal. We have to have that the total assets that have been recorded equal to 114,700, and the total liability is 60,900 plus equity, which is 53,800, which means at the end we kept that equality between the two. How did we know that? By posting. If you opened a T account like that one and you start posting from the journals that we just finished and getting all the debit side in one, all the debit transaction of cash in one side and the credit transaction in the other side, and I will add both sides up, the balance will be called balance, the difference will be called balance, and here the balance will be in the side of the bigger number. This means that we received cash and we pay it cash, and at the end the remaining is 12,200. This is called the ledger account. This is why it is said here that ledger report the ending balances in the asset account after the journal entries are posted. The same have been done for the account receivable. 3,000 increase in the account receivable, 2,000 have been collected, so actually we're still entitled to receive another 1,000. Office supplies, we purchased 5,000 of supplies and it is still there, so actually this is the balance. We didn't use any of that supplies yet. Prepaid expenses, we paid 3,000 in advance, but we didn't get use of any of that rent yet, so actually it is again 3,000. Furniture is the same, building, land, and the addition of the asset is 114,700, and this is previous slide. So actually now to conclude, we have all of the assets here with a total of 114,700. The liabilities, okay, and don't forget unearned revenue is a liability with 6,900, and equity including contributed capital, common stock, retained earning, dividend, service and rent expenses with a total amount of 53,800, and both sides are said before. So actually up till now we moved in the accounting cycle from analyzing the transaction, recording in the general journal, which is debit and credit. We did T account to get the balances. The fourth step is to have something we call the trial balance. Trial balance actually will come later in order to show did we comply with the equality between the debit side and the credit side or not. Like for example here, if you are seeing the posting references, these are transactions that happened in the previous slides. The first one was cash and common stock, and we have a posting reference, which means this cash have been posted to the T account. This is another shape of the T account. Okay, يعني we don't care actually a lot about that shape because we are always concentrating on the T account. It will be much easier, but actually you have to be familiar with the other forms or formats of the T account, and it is the same because actually it is item post reference. It came from J1 journal 1, debit 30,000, so the balance will be 30,000. The common stock have been credited for 30,000. It came from J1, okay, and here it have been posted to account number 301, so it is credited for 30, so the balance will be 30. Prepare trial balance. This is what I was talking about. The trial balance will include all the final balances of all the account in the debit side and all the balances, the final balances of the credit side. If you can see here, this is assets, right? This is dividend, as we said before, and this is expense. The three accounts that we said they have the same, okay, treatment. On the other side, you will find liability, equity, and revenue. Okay, so actually here we have to summarize the balances of all the accounts in order to show that we followed the right manner in recording posting, and this will be known from knowing that here the balance of the left hand side, which is the debit side, equal to the right hand side, which is the credit balance. So actually the trial balance is a summary of ledger listing all of the account with their balances, and the assets accounts are listed first, followed by liability, and then equity, revenues, and expense. At the end, from the trial balance, we have to prepare the financial statement, which we discussed in chapter 1, because actually now you have the end balances of all the accounts. So actually we'll start preparing the income statement, taking revenue and expenses. Then whenever you arrive to the net income, you will go to the statement of retained earnings, starting by retained earning balance, which is 0, net income that have been calculated here, subtracting dividend, and then to get the retained earning end balance. And this total is the one that have been included here, because in the balance sheet you have assets, liability, and equity. The part of the equity have been calculated already in the statement of the retained earning, including then or added to the common stock balance. Then we reach it for the balance sheet where both sides again are equal. Actually, we reach it for a point that we prepare the financial statement from the trial, okay, balances. So actually, if you have a problem that the two sides of the trial balance are not equal, we have to search for the missing account. Some theories say that dividing the difference between the total debit and total credit by 2 means a debit treated as credit, or vice versa doubles the error. Yani we misplaced the debit and credit, so actually this have to be checked. Others are saying divide out of the balance amount by 9 to find the transposition error, the amounts that have misstating the trial balance. All of those are theories that we can apply, or we can go and check depending on our, you can see. Last, we are talking about debt ratio, and the debt ratio is the proportion of asset financed by debt. How much of your assets are financed through liability, and it can be used to evaluate business ability to pay its debt and to determine if the company has too much debt to be considered financially healthy. The higher the debt ratio, the more risky is the company, the less healthy is the company. So actually this is a very important ratio, and it is sequential to the ROA that we discussed in chapter 1. By that we reached the last or the end of that chapter. In the next chapter, inshallah, we are going to start talking about the adjusting entry. Thank you for listening. Seeing you next class, inshallah.